The rate angst of March bled into equities in April and has tipped U.S. small-cap stocks, the Nasdaq index, and select international markets into bear market territory. The most speculative parts of the market have been hit the hardest. Cryptocurrencies Bitcoin and Ether fell 23% and 30% respectively, while the stablecoin Terra lost effectively all of its value in just 6 days. History suggested that the rate hikes expected at the start of the year would have a benign impact, while the current higher pace suggested a much worse outcome, as has been experienced. So is the stock market signaling an impending recession, or is this more of an adjustment to higher rates and slower growth? Let's take a look. Credit markets are evidencing increased concern, with credit spreads increasing significantly over the last month. The jump in April consumer prices was higher than expected, and the increase in mortgage interest costs and gasoline prices are material growth headwinds. The US dollar surged 5% over the last month and is up 16% over the last year. While this can help limit imported inflation, it can also hinder export growth. The yield curve is still positively sloped, however, with the difference between the 2-year and 10-year yields at 33 basis points and the Fed funds to 10-year curve a robust 2 percentage points. We have come through first quarter earnings in good form in the US, and forward estimates have edged up. This means the decline in stock prices has all been driven by a drop in valuation, a long-term positive. The global economic outlook changed meaningfully when Russia invaded Ukraine in late February, hurting growth prospects while increasing inflationary pressures. Our base case of global economic shocks encompasses this environment, alongside the negative impact of China's zero-COVID policy. Much of the market concern centers around how far the Fed has to go with rates, which captures our "a relentless Fed" risk case. Economic degradation is our other risk case, reflecting the risks to the U.S. expansion from weakness outside of the U.S. alongside higher interest rates. We think the recent market weakness is tied to both the repricing and also concerns about the potential for recession, which we think will be avoided. We made no changes in our global policy model this month, where we are neutral on equities and tilted toward the U.S. We also continue to favor natural resources, which are benefiting from tight supplies and inflationary concerns. Finally, we think the increase in credit spreads represents an attractive risk return for high-yield bonds, especially when compared with equities.